All right, let's dive into a topic that I know might sound a little dry: accounting standards. But I promise you, this one is a powerhouse. It totally changed the game for how companies report what they pay their people. We're talking about IFRS 2 and the world of share-based payments. But to really get why it's so important, we have to start with a kind of crazy question. So let me ask you this. How could a company give its employees, say, millions of dollars worth of compensation, and have absolutely zero, zilch of it show up as an expense on their profit and loss statement? I mean, that sounds impossible, right?
Well, the wild thing is, for a very long time, it wasn't impossible at all. It was just how things were done. You see, before the early 2000s, companies could hand out incredibly valuable stock options, a massive slice of executive pay, without recording a single penny as an expense. It was a huge accounting loophole.
Okay, so here's how we're going to unpack all of this. We'll start with the problem itself, then we'll introduce the rule that came in to fix it. After that, we'll break down the two main ways these payments work, and we'll wrap it all up with the bottom line: why any of this actually matters to you.
So, what was the big issue here? Well, to put it simply, the accounting books weren't telling the true story. You had this enormous amount of value, real value, being handed over from the company to its employees, but from an accounting perspective, it was invisible. It was treated as if it had no cost at all. And that's where IFRS 2 comes into the picture. Rolled out back in 2004, this new standard was designed to do one thing: slam that loophole shut. The whole goal was to force a company's financial statements to actually reflect the true economic cost of paying people with things like shares and stock options.
And hey, you don't just have to take my word for it. The standard itself is crystal clear. It says the whole point is to reflect the effects of share-based payment transactions in a company's profit or loss. In other words, if it looks like compensation and it acts like compensation, you have got to account for it as compensation. Simple as that. Now, IFRS 2 actually covers a few different situations, but we're going to zero in on the two big ones. First up, you've got equity settled deals. This is where employees get actual shares or options. Then you have cash settled transactions, where they get cash, but the amount they get is tied to the company's share price. There is a third kind, but these first two are by far the most common. So let's kick things off with equity settled. This is your classic stock option plan. The company is literally giving its employees a piece of the pie, right? A direct stake in the future success of the business. Okay, to understand how the accounting works here, you have to get two key ideas. First is fair value. That's basically what the options are worth on the day they're given out. And second is the vesting period. That's the amount of time an employee has to stick around to actually earn those options. So here's how it plays out. On day one, when the options are granted, the company figures out their total fair value. But, and this is key, it doesn't expense that whole amount right away. Instead, it spreads that cost out evenly over the vesting period. So if the options vest over, say, 3 years, 1/3 of the total cost hits the income statement each year. Then, boom, once the vesting date arrives, the full expense is on the books, showing up in the equity section of the balance sheet. All right, let's switch gears to the second category: cash settled. Now here, the company isn't promising to hand over shares. It's promising cold, hard cash. The catch is that the amount of cash they'll get is directly tied to how the company's stock is doing. Think of it like a bonus that gets bigger or smaller depending on the share price. And this is where it gets really interesting, because the accounting is totally different. With an equity settled plan, you give away equity, so you record an increase in, well, equity. Make sense? But with cash settled, you're promising to pay cash later, so you have to record a liability. It's a debt you owe. And here's the biggest difference. For equity, you figure out the fair value just once, on the day you grant the options. But for this cash liability, you have to recalculate its fair value every single reporting period until you pay it off. And this shows you just how risky that can be. I mean, what happens if the company's share price just goes to the moon? Well, the value of that cash liability you owe also skyrockets. This can create these wild, unpredictable swings in the expense you have to report, which can make a company's profits look like they're on a roller coaster. From an accounting standpoint, it's a much more volatile game. So let's pull all of this together. What's the real takeaway here? Why does a technical accounting rule like IFRS 2 actually matter to anyone who's not an accountant? Because it's about so much more than just recording an expense. The real power of IFRS 2 is transparency. It forces companies to open up their books and disclose everything about these plans: what kind they are, how many options they're giving out, how they even calculated the value, and most importantly, the total cost that's hitting their bottom line. It gives investors a way clearer picture.
So ultimately, it boils down to this. Yes, by making companies expense these payments, IFRS 2 often leads to lower reported profits. But what we get in return is a massive boost in transparency. For the first time, investors can see a complete and accurate picture of a company's performance without these huge hidden compensation costs lurking in the shadows.
And that leaves us with a final question to chew on. IFRS 2 was built for a world of shares and options. But today, companies are getting creative, paying people with everything from crypto to other digital rewards. The core idea of IFRS 2, that all compensation has a cost, is more important than ever. The real question for the future is, how are the accounting rules going to keep up to make sure that the financial story we're being told is always the true story?